At $2.87 per share, this is a small-cap company operating industrial-scale facilities packed with high-density computing machines that run 24 hours a day. Not software. Not a speculative AI model. Physical infrastructure. Warehouses filled with specialized hardware consuming megawatts of electricity and converting that power into digital output. Yet the market is valuing the entire operation at a level many single data center racks inside hyperscale campuses exceed. That's the asymmetry. A few years ago, this same stock traded dramatically higher during a surge in demand for computational throughput tied to digital assets. Since then, volatility, debt concerns, and sector skepticism have compressed its valuation. But here's the tension: the physical infrastructure didn't disappear. The power connections didn't disappear. The high-density compute footprint didn't disappear. Only the narrative did. This company operates large-scale facilities designed to house and power thousands of application-specific integrated circuits, ASIC machines engineered to perform cryptographic hashing at industrial efficiency. These machines are deployed inside purpose-built data centers in North America, connected directly to substantial energy sources, optimized for airflow, cooling, and continuous runtime. The core output today is Bitcoin network validation through proof-of-work mining, but the underlying asset is not just digital tokens, it's energy-secured compute capacity. And that's where things get interesting. Because the world is entering a period where high-density compute and power availability are becoming strategic constraints. Artificial intelligence training clusters, inference farms, and advanced computational workloads all require massive, stable energy supply and specialized facilities. But there's a reason the market hasn't rewarded this stock yet. Its revenue is still tightly linked to cryptocurrency economics, which introduces volatility and cyclical perception risk. So the question becomes, is this just another crypto miner riding Bitcoin price swings? Or is it an overlooked compute infrastructure operator sitting at the intersection of energy and processing demand? Over the last several years, the broader compute landscape has shifted dramatically. AI training models are pushing electricity consumption higher. Data centers are facing grid bottlenecks. Utilities are warning about capacity stress. Governments are discussing energy allocation for digital infrastructure. Compute is no longer just about chips, it's about power contracts, grid access, and industrial-scale cooling systems. This company already operates in that world. Its facilities are structured to secure long-term power agreements, optimize cost per kilowatt-hour, and deploy specialized hardware at density levels far beyond typical enterprise server rooms. Revenue is generated by deploying ASIC fleets that validate blockchain transactions and receive Bitcoin rewards. That revenue model is transparent but highly sensitive to Bitcoin price and network difficulty adjustments. When digital asset prices fall, margins compress. When energy costs rise, profitability narrows. And that cyclicality has weighed heavily on valuation multiples. But infrastructure is sticky. Power connections at industrial scale are difficult to obtain. Grid interconnection approvals can take years. Building new compute-ready warehouses with appropriate cooling and electrical engineering is capital-intensive. So while markets often price these operators as speculative crypto vehicles, the physical layer resembles energy-backed compute infrastructure. There's another layer to the disconnect. Many institutional investors avoid crypto-adjacent equities entirely. That reduces liquidity and compresses coverage. Smaller market capitalization amplifies volatility. Add prior debt restructuring headlines and the stock becomes easy to ignore. Yet operationally, the facilities continue running, producing digital output every minute of the day. And here's the subtle angle. As AI workloads expand, the industry conversation is shifting toward repurposing or hybridizing high-density compute sites. Not all ASIC infrastructure is transferable to GPU workloads, but the underlying expertise, power procurement, facility management, thermals, uptime optimization, is transferable. The market rarely prices optionality when sentiment is negative. By now you might be wondering which company this actually is. The business is Argo Blockchain plc, trading on Nasdaq under the ticker ARBK, currently priced around $2.87 per share. Argo Blockchain plc, ADR operates Bitcoin mining facilities, primarily in North America, leveraging large-scale power agreements to run fleets of specialized mining hardware. Its flagship operations have included high-capacity sites designed to scale computational output efficiently. As an ADR structure, it gives U.S. investors exposure to a UK-based digital infrastructure operator. So why is the stock still sitting under $3? First, revenue concentration risk. The majority of income is tied directly to Bitcoin price dynamics. Second, historical leverage concerns and past balance sheet stress reduced investor confidence. Third, crypto mining faces regulatory uncertainty in some jurisdictions, especially around energy consumption narratives. And finally, market perception tends to lump all miners together without distinguishing operational efficiency or infrastructure quality. Yet, in periods where Bitcoin stabilizes or appreciates while energy contracts remain competitive, margins can expand quickly. That operating leverage works both ways, but it also creates catalyst potential. Additionally, if digital asset adoption continues integrating with financial infrastructure, mining capacity becomes part of broader network security architecture. Looking forward, several factors could influence trajectory. Bitcoin price cycles remain the primary driver. Energy market conditions, particularly in North America, will impact cost structure. Potential diversification into hosting services or strategic compute partnerships could alter the narrative. And macro conversations around grid capacity, AI compute growth, and digital infrastructure expansion may slowly shift how investors categorize companies like this. But risk remains real. Bitcoin halving events reduce block rewards, forcing efficiency improvements. Hardware obsolescence is ongoing in ASIC markets. Regulatory shifts could affect operational flexibility. And capital raises could dilute shareholders if expansion requires funding. So we return to the original tension. At $2.87 per share, the market is valuing Argo primarily as a volatile crypto proxy. But beneath that label sits physical, energy-secured compute infrastructure operating continuously. Whether that infrastructure evolves, stabilizes, or remains tethered to crypto cycles will determine long-term valuation direction. This discussion is for educational purposes only and not financial advice. The objective is to analyze how small-cap infrastructure operators function, how their revenue models interact with macro forces, and why valuation sometimes disconnects from physical deployment reality. In a market focused heavily on headline AI leaders and hyperscalers, smaller compute-intensive operators can either remain overlooked or become re-evaluated when narratives shift.